Hello friends, welcome to my channel. So today I'm going to talk about two important insurance and their difference. So let's begin. So today I'm going to talk about the difference between life insurance and the mortgage insurance. So how life insurance can work and how mortgage insurance can work and what are the key benefit and key takeaway with both of these insurance. So let's get started. So let's talk about life insurance first. So, in general term, what is life insurance? So many of us know that life insurance is a contract providing a tax-free lump sum payment to the beneficiary upon the insured's death. That means if you purchase a life insurance of your own and something happens to you, in that case, the coverages are money goes to your beneficiary, so which is a simple definitions of a life insurance. So why we need a life insurance? So many of us know don't have a life insurance, like in Canada, like many people don't have life insurance. So why we need a life insurance? So first, life insurance is needed to protect your loved one. Mm. Second, it's also needed to cover your debt, uh, and it's also needed for your income replacement. For example, suppose you're in a family main bread earner, and if something happens to you, then who's gonna how your family is gonna survive? So in that case, if you have a proper coverage, so anything happens to you, your loved one, your family can survive. So that is the main reason that we should have a proper life insurance. Now, talking about types of the life insurance. So there are basically two types of life insurance, which is called a term or temporary life insurance, and a permanent, which is we call a lifetime coverage or cash value kind of life insurance. So I'm not gonna go into much detail about the term and the permanent uh, uh, insurance, but it's just a type of insurance, term and permanent insurance. So it's essential for protecting dependents and securing a financial obligations like a mortgage. So that is the reason like we want a life insurance because if we have a mortgage, then if something happens to us, then obviously we can pay off our mortgage from that coverage amount. So that's why we need a life insurance. So let's talk about some of the benefits. So what that debt benefit is. So if you have a life insurance, something happens to you, so the money are tax free and it goes directly to your beneficiaries. So beneficiaries may be either your wife, your parents, your kids, or anyone. You can choose your beneficiary. Now let's go in some detail about the types of life insurance. Let's say talk about term life insurance. So what is term life insurance? Term life insurance is provide coverage for a specific period, for example 10, 20 or 30 years. So ideal for the temporary needs like covering a mortgage or until your children are independent or something like that. Means your if you have a debt, if you have a mortgage, or if you want your children protect your children, or if you want to in income replace your income, so in that case you have to take a term life insurance. Now on the other hand, permanent life insurance, what it does it means? So it provide coverage for a life. It means in a term life insurance your coverage is either 10 years, 20 years, 30 years, 35 years. So after that your coverage is you are no longer covered, and anything happens after that, the companies or the insurance company not gonna be pay you anything. whereas in a permanent life insurance, it goes up to the life of the insured person. So if anything happens throughout their life, let's say the person buy an insurance at the age of 25 or 30, and its coverage is like a lifetime. So at the age of 90 or 80, something happens to him or her, so money goes to their beneficiary. So and it also has a cash value. Now, why why person needs a life insurance? So like I said, it protect the loss of income, cover the debt, and provide a children's education and help in the funeral costs. So these are the reason why people go for life insurance. Now, which insurance should I choose? Because the questions comes in everyone's mind, because there are like two types of insurance: term life insurance and the permanent life insurance. So what should I do? Whether I should go with the term life, or just go with the permanent life. It's not like a random that you can choose like term or permanent. It totally depends on like your financial need and your dime theory. It's very important that every individual must go through this dime theory, which helps them to decide which proper coverage or what amount of coverage should I go with and what type of insurance should I take. So let's go into dig into this dime theory. So what dime matter? It's just a formula for calculating a life insurance need by totaling four key financial area like debt, income replacement, mortgage, and education expense. Means like if you want to purchase an insurance, so first you should think about your calculating based on your dime method, like what amount of debt I have, what what is my income replacement and how long I need an income replacement, what is my mortgage, and what is my children's education expenses. So based on these all parameter, you just have to select or go with that coverage. Let's go into take someone one example, like let's say your debt is $50,000. So what does it 50,000 that includes? It may be your credit card debt, it may be the money you borrowed from someone or something, someone, and you have to pay that amount. That's, let's say it's a debt. Then like 700,000. What does it 700,000 comes from? So it is like your 70K income a year, and if you think like you need uh, 10 years of that protection, so if you multiply by 10, so it give you 700,000. Then let's say you have a mortgage of 300,000, so you had that amount, and like you are thinking to have an education for your kids which is around like 100,000. So all sums together based on dime matter is require 1.1 million coverage you needed. So it's like a sufficient for you if you have these money debt and income or mortgage or education cost is. So this is how you can choose your coverage. So now, why use the diameter? Like why should I use it? Because it's cover immediate debt and long-term financial goal. Because like your debt is like $50,000 and your income, let's say in this example, 700 or 70K, and if you think like something happens to you, so at least uh, 10 years after that your family gonna survive in the same or live as the same as you are living right now. So that's why you put 70K into 10 years. So you think like your family need at least 10 years to settle down, and they need 70K a year to a reasonable life after anything happens to you. So that's why you choose that amount. Now customize, like focus on your specific financial situations rather than genetic multiplier. That means like you cannot randomly put like, okay, So my mortgage is 300,000. Let's put like 500,000, or education's like I need 300,000 rather than 100,000. So it's not like you can put any generic number. It's kind of totally based on your debt and income and mortgage and education. So based on that, you choose your coverage amount and then you just go with the insurance. So it's like it's easy to use and it's straightforward calculation using known personal financial number. We call it as a financial fin number. Okay, so this diameter is very useful while selecting your type of insurance or the amount or coverage of your insurance. So do not randomly buy, let's say if your need is like 1500, or like if your need is like half a million, and you don't need to buy like 2 millions or 1.5 millions of coverage. You don't need it. So it's always try to choose or try to select the coverage which you needed, not someone suggested, and also not someone told you that's why you need that coverage. So always go with this diameter and think smartly and choose your coverage accordingly. So now let's go on to the other insurance, which we call it as a mortgage life insurance, or nowadays people call it mortgage insurance. So what is mortgage insurance? So mortgage life insurance is an optional lender offered policy that pays off your outstanding mortgage balance if you die, ensuring beneficiaries can remain in the home. So for example, uh, you bought a home worth of like $1 million, and you bought a mortgage life insurance. So if it's anything happens after like 5 years of your mortgage, and if you have mortgage insurance, if anything happens to you, then the mortgage insurance can pay off your mortgage to your financial institution, so your family can remain in their home, so they don't need to worry about their mortgage expenses. Now what are the purpose of this insurance? So the main purpose of this insurance, like we are already talked about, is to prepare your loved ones from inheriting debt and ensure that they can stay in the home. So it's just pay off your mortgage, whatever the mortgage, like it's if it's in the home. So if you bought a mortgage insurance for your home, so if it's pay your mortgage insurance, so you can stay that in your home. Now payout, it's directly payout to the financial institution. So unlike in a life insurance where anything happens to you, the payout is directly to the beneficiary, whereas in mortgage insurance, the payout is directly to the financial institutions. So uh, it's not paid to your family. So that's a mortgage life insurance. So coverage amount generally decrease as your mortgage principal decrease, while the premium often stays same. So what does it mean? Is a drawback of a mortgage life insurance. Like I said, if you bought a house of $1 million in let's say in 2025, and you pay the mortgage insurance of let's say $250 a month. It's a hypothetically, I don't know the exact amount, but let's say for $1 million you are paying $250 for your mortgage insurance. Now if after 5 years your mortgage amount is let's say mm, 900,000 or 800,000, but still you are paying $250, whereas in a life insurance your coverage remains the same and your premium is also remains the same. That is the advantage in the life insurance, whereas here the drawback is the as your mortgage decreases, your coverage remains the same, your premium remains the same. So even if you are like you paid like most of your mortgage, let's say your outstanding mortgage is just like 100,000, still you are paying $250 premium for the same mortgage. And at the um, beginning of the buying your home, let's say at the beginning it's $1 million. At the time also you are paying 250, and when your mortgage remains like 100,000, your premium is again 250. So which is kind of you are paying same for all the your generally at the decreased mortgage. So this is one of the drawback. Now who's eligible? What are the eligibility of the eh, uh, eligibility of your mortgage life insurance? So it's available to Canadian resident at the age of 18 to 64 who are on the mortgage. So mortgage insurance, obviously as the name suggests, that it's already given to the person who has a mortgage, whereas life insurance, you can buy life insurance at any age, but it's recommended to buy it at age of 18. uh, Parents are also sometimes buying life insurance for their children's. So, and you can buy it, life insurance at any age, but for the mortgage insurance, the age limits are 18 to 64. Now let's go on the difference between life insurance and the mortgage life insurance. So yeah, here is a life insurance. In that case, I took the example of term insurance, term life insurance, and this the typical lender mortgage insurance. So what is the key difference between this life insurance and the mortgage insurance? So let's go on the first. So you choose the amount of coverage and your own the policy. So means in a term life insurance, the coverage amount is choose by you, and the policy is also choose by you. Means like I said, you are calculating dime based on dime matter, and you end up with like, I need half a million, or I need 600, or I need $1 million insurance based on your own uh, own dime matter calculations, and this policy is your own. Whereas in a mortgage insurance, the amount of coverage is dictated by the amount borrowed, and the lender owns the policy. So means what? So amount of coverage is not dictated by eh, you, because it's mortgage insurance. So the amount of mortgage you have, that should be your mortgage insurance. And who owns the policy here? It's most key difference is in the mortgage insurance, the lender is the uh, own the policy, whereas in the term life insurance, you are the you own the policy. So anything happens to you in your own policy in term life, money goes to your loved one. Whereas in mortgage insurance, anything happens to you, money goes to the lender or your financial institution who from whom you bought your mortgage. So that is the key benefit that we should consider. Next one is cost stays the same and the coverage stays the same. As you can see in even graph 2, your coverage is same, your cost is same. Let's say you choose your coverage based on nine methods like $1 million, so your coverage remains $1 million in this term life insurance, let's say for the 30 years. So it remains in 30 years same 1 million, and your cost same at the beginning, let's say $200. So you're paying $200 for the rest of your 30 year for a million year, for the $1 million. Whereas in a mortgage insurance, your cost stays the same, but the coverage declines as the mortgage is paid down. It's really disappointing where you are paying same at the beginning because your coverage is like $1 million. Now as you go on, time passes, you pay your mortgage, and let's say at the at the at the very end of your mortgage, you're also paying the same cost. So at the beginning, your coverage, let's say it's $1 million, you're paying 250. Over here at the end, your coverage, your remaining debt is like, now it's like 100,000. Then again, your cost is same. So ultimately, you are paying more and your coverage is less. as the time passes. So that is one of the drawback of the mortgage insurance. Now, choose the beneficiary. So another great benefit of the life insurance is you choose your beneficiary, means your parents, your wife, your children's. You can choose any of your family member as your beneficiary, whereas in a mortgage insurance your lender is the beneficiary, means you do not have control to choose your beneficiary. So anything happens to you, the money goes to the beneficiary. That is your mortgage institute from where you took your mortgage. So means your family don't get anything unless just the home, in that case if you have buy the mortgage insurance for your home. So that's the another drawback of mortgage insurance. Now, what other benefit is, insurance remains in the effect as long as you pay the premium or decide to cancel. So that means in a life insurance you own the policy, so you are the policy holder, so you can decide whether you wanna continue with the insurance, or I just wanna cancel this insurance. Whereas in the mortgage insurance you lose the coverage when the mortgage is repaid, means at the end of, let's say your mortgage is 25 years, at the end of the 25-year you don't have any insurance. If anything happens to you, your loved one is in a trouble because you don't have money. Whereas here in the insurance, term life insurance, if anything happens to you at any age during your premium, your money goes to your loved ones. So this is the one another key benefit of life insurance. Now, other another good benefit of life insurance is fully portable even if you move your mortgage. Whereas in a mortgage life insurance, you have to requalify for coverage if you move your mortgage. That means these life insurance has nothing to deal with your mortgage. Let's say after 5 years you change your mortgage, or if you're moving from townhome, let's say from to the semi-detached, so your mortgage, your insurance remains the same in the life insurance. Whereas for mortgage insurance you have to qualify again, your premium is adjusted based on that, your new mortgage. So which again it's you are paying more again, and it's not suitable to have in, if in this case, to go with the mortgage insurance. Now, the other benefit of these life insurance is unique rates based on the gender, age, health, and smoking status. Lower premium for healthy clients, means in a life insurance your your coverage and your premium is depends on your gender, your age, your health, and your smoking status. It means there is a medical examinations happens. Based on that your premium is decided, and generally it's lower premium for healthier kind, because if you're healthy, there's the chances your chances are your premiums are lower. Whereas for the mortgage insurance, the rate the same for all client for the same age for them, because they are just uh, giving you mortgage insurance, so they have a same rate for all the clients. Let's say one client has age of 30 and bought a home of $1 million, has the same insurance, same premium like $250, where and this the same $1 million home purchased by like a 55-year-old person has the same uh, premium, because they only mortgage insurance only deal or only taken care of their mortgage. So which is here it's the same for all age. Then another key benefit of life insurance is protect whatever you want, like the family, education cost, debt, repayment, etc. Like I said, it's protect because you choose the coverage based on your dime method. So if you choose from the using dime method, so it protect all your needs, like your family needs, your education, your debt, your cost, your repayment, everything you're considering when you uh, buy the life insurance, whereas for the mortgage insurance may only be used to pay off the mortgage. So let's say if you have $30,000 debt, and if something happens to you, they just cover your mortgage, not the 30,000 that you had from your credit card or from borrowed from someone. They also not cover your educational costs. They also not cover your funeral cost. Whereas in a life insurance, you, because you choose your coverage, you choose your uh, coverage and amount, so it's all covered. So anything happens at that time, your family can not also pay your mortgage but also have secure life for their children and pay all their debt. So this is how these life insurance is key and it's important rather than the mortgage insurance. So in my personal suggestion, I would go always with the life insurance over the mortgage insurance, because there are number of benefit which is not there in the mortgage insurance. So always go with the life insurance, term life insurance, because in term life insurance your premium is less, and it's good to have your life insurance sooner is better, because as your age, if you are getting older and older, your your premiums gonna be go up for the same coverage. So it's better to take a life insurance as early as possible, so you will covered and you can have protected your family. So always take a life insurance over the mortgage insurance for my personal suggestion. So this is all about the life insurance and mortgage insurance. So if you have any questions, any doubt about these, so please let me know. And thank you for watching this video. If you have anything, just comment on, share this video to someone who have a mortgage insurance, so they can aware these difference and they can choose their proper life insurance. So thank you watching my video, and if you liked my video, so like hit the like button, share, subscribes. So thank you and have a good day.